onto the market darlings, we'll call them. The Precision Funds Management number one fan is the number one fan of this company, Capricorn Metals. They've delivered another stock standard quarterly result in line with guidance out on the 5th of April. Nice and just efficient, not dragging the chain at all. 30,000 ounces, 30,800 ounces with delays as well. Not everything went their way this quarter. We've got a lot to talk about, not just this announcement, but why this company is one of the market darlings on the ASX in the gold sector.
Yeah,
Lads,
I think
this is going to be the best chapter in Money and Mine histories to date, I reckon.
no pressure there. So I think you've touched on some of the highlights pretty well there, Matty. This is a company that hasn't suffered from any of the cost overruns, cost inflations that we've seen across the industry over the past couple of years.
How? I do not know how. Everyone else is going up in their all-in sustaining costs, but Capricorn have maintained theirs.
Matt, I can't quite put my finger on it either. They've got a good relationship, we understand, with Macca, but whatever the relationship with the contract miner, they've just managed to keep chugging along. Like you said, just under 31,000 ounces. That puts them right on track to meet guidance of between 115 and 125,000 ounces for the financial year. Costs are coming in at about 1,200 all-in sustaining costs. So they're on track, like you said, despite a weather event earlier this year. And also they had an unscheduled mill maintenance that they had to do. So this is a company that's really focused on margin over ounces. We've seen in the last couple of days a number of companies announce this. Capricorn isn't so flamboyant about it. They're not making big announcements. They just do the job. They just focus on the margin over the ounces. So that's served them really well. At their low all-in sustaining cost, they're producing about $25 million in free cash flow. And with the phenomenal M&A deal that they did last year to acquire Mount Gibson, it puts them in a great position to be able to develop that asset and perhaps with a bit more debt, not have to dilute the shareholders anymore and get that asset online in a few years' time. So with all this positivity around Capricorn, it is pretty baked into the price. They're trading at about 10 times EV to EBITDA of the next 12 months earnings.
I think that's, that multiple that they trade at 10 times, that is, it's pretty remarkable when you compare it to their peers. All of the peer gold producers do trade at between 3 and 5 times, the forward-looking EBITDA. However, in Capricorn's case, you can explain some of that away by the fact that, in that forward-looking year, 43% of their production is hedged. So the market's looking forward further than the next year and saying they're going to produce even more money in the future, hence we'll pay a higher multiple on the next year's earnings. However, they're still really, highly valued. They're always at the top of the deck when you do any sort of valuation comparable analysis. And on a price to NAV basis, for example, they come in at about 1.05 times NAV versus, Regis at 0.92, where Mark Clark's sort of, come from and his team sort of, come from. So they're baked into that price today, you are paying a premium for the excellent management team that you're getting with this company. And one more thing on Capricorn is every time I look at an announcement from this company, and anyone that's ever looked at an announcement from this company has probably had the experience of thinking, do these guys format this? Do they put any effort into making this look good? And today's announcement, there's a graph, and the graph looks like it's been produced from Microsoft Excel 1995. It's in 3D. It looks horrible. But what I can tell from that is that this company is not getting bankers to put together their announcement or presentations. It's bare bones, and quite frankly, it reminds me of, if you've ever looked at the Berkshire Hathaway website. So that Berkshire Hathaway, Warren Buffett's investment vehicle, of course, it's a plain text website, and I get the same sort of feeling when I look at this company.
Yeah,
I think their Diggers presentation, it was the DNA of a no fuss company. I'm getting the words wrong there, but you do really get the picture that these guys know what they're doing it well, and they're not screaming and shouting about it from a marketing perspective.
Absolutely. And like Berkshire, these guys are just laser focused on costs, like any good company. So just to round off on CMM, we were expecting the Mount Gibson maiden ore reserve in the March quarter. So any day now, we should see that come through.
Now, Trav, before we go on to the next one, for the listeners that aren't from the finance world, the EV to EBITDA multiple, why is that used as a good indicator for where stocks are trading and popularity?
Yeah, you can,
and probably define it as well.
Yeah, so EV is basically what the business is worth if you took the cash and debt out of the equation. So it's kind of, if you just looked at the ability of this company to generate cash flow over time, EV is sort of what you pay for that. And EBITDA is, the earnings that this company is basically producing. But EBITDA is a modified version of that earnings. It's earnings before interest, tax, depreciation, and amortization. But you can just think about it as the ability of the company to make money. So how much the market is valuing the company divided by the ability of, what the earnings of this company actually is.
Yeah, I think it's worth noting as well, DNA, a part of that EBITDA, is a huge part in the mining industry, perhaps more involved in mining than most other industries out there. So it's just a proxy for cash flow, and it's not a definitive sort of statement.
And the higher that ratio, the more popular the market see that.
Well, the more fully valued the stock is, and there's usually good reasons for that. Of course, you can go out there and buy a mining company on, 2 times EBITDA. There's a good chance that company's going to have to hit the equity markets for more capital because they've got some working capital issue there. So usually the market's pretty clever, and it ascribes a full premium to good companies with good management teams, and I think that's what we're seeing in Capricorn trading on 10 times forward-looking EBITDA.
And I doubt they pay for investor relations or sponsorship or anything, but they've got great blokes like us that just absolutely plug the crap out of them on YouTube. So, God, lucky them, I guess.